Hey guys, Cam for Investors Underground here. Welcome to Lesson 2 of our Beginner's Trading Guide from the Investors Underground community. If you haven't seen Lesson 1 yet, you can click this button here. It'll take you over to Lesson 1 because you really should start there. We've got a ton of great feedback from Lesson 1. People are really pumped up to see the series and it gets me excited about making them. As I said in the previous video, we've got a 24 video series planned with 8 lessons in the Beginner's Guide, where we're going to be covering a ton of information. 8 lessons in the Intermediate Guide, where we're going to be expanding on the Beginner's Guide and also covering some new topics that relate more to growing pains as you're trading. And in the Advanced Guide, we're going to look into some more in-depth trading theories that you only really get through lots of experience in the market. You can find new videos on the Investors Underground YouTube channel every Wednesday, and I'm going to be putting out one of these lessons every 2 weeks. If you want to make sure that you don't miss out on any of them, then you got to subscribe to the channel. It's free. All you need to do is click a button and you can do that here. All right, Nate, let's get into the action.
Thanks, Cam. So we're going to be going over what are charts. And what that is it's a visual representation of price over time. It tracks every single transaction and plots them on a chart. And it allows you to view that in either a candlestick, bar, line, and many different types of charts. The most popular and what I use is the candlestick chart. Personally, I use a 1-minute chart, but you can look at it in many different time frames, whether that be 5-minute, 10-minute, daily chart, and many other different ways. One of the most important aspects of the type of trading that I do is it involves momentum, and that's volume. So I want to be able to see exactly what type of volume any particular stock is trading. And that's shown on this chart, which is called an overlay. You can also do many different types of overlays. One which we'll be getting at later on is called the VWAP, which I use on the intraday chart. So you can see where most of the volume has exchanged hands on any given day. There are tons of different indicators. Some are the Bollinger Bands, MACD, RSI, but from my experience of looking through these charts before and after, some of those indicators look nothing like what they look like after the fact as you're approaching a potential move. So I like to keep it simple and just use volume, VWAP, over a candlestick chart. The main reason that we like charts is it allows us to focus on patterns that we've seen before. We don't have to worry about whether or not a company is good or bad if we're just focused on patterns that are setting up that we've seen more often than not break out higher, or on the flip side, patterns that we've seen break down more often than not. What we're looking for is high probability setups. We're not looking to see what a company may be worth. We'll leave that to the talking heads. But what we're looking for is to find the best probable chance, whether that's a breakout or a breakdown. It happens intraday, intra-minute, and we're not interested over the long run. This type of trading is based on pattern recognition versus valuation. So you heard me mention that we trade candlesticks. So let's check out exactly what they are. A candlestick is like a mini story. From this candlestick that we have right here, you can find out 4 pieces of information. The highest point that it went, the lowest point that it went, where it opened, and where it closed. This candle could represent 1 minute, it could represent a 15-minute candle, or it could represent an entire day. When you're looking at a candle, from the very top to the very bottom is the range on any particular time frame. The area in which is enclosed is the difference between the open and the close, and the extremities that poke out of the body are called the wicks. And that can symbolize exactly just how high it went and how low it went, but depending on which color the candle is, determines whether it has closed lower or higher than where it opened. So as you look at this candlestick, the 4 pieces of information that you receive are that it opened here, and then it pulled back to this low. It made a new high shortly thereafter, and then pulled back by the end of that candle just a small bit and closed right here. If we didn't have the wicks, we'd just see the open and the close. But because we do, we can actually see the entire range for any given time period. Because this candle closed higher than where it opened, the candle is green. As I mentioned, the body is green when it closes higher than where it opened. And as you can see, it opened here and it ended up closing here. So this one's green. On the flip side, if you take a look at this red candle, you can see that it opened here and it ended up closing here, and therefore the body is red. This will make a lot more sense once we go through a couple examples. So I guess that brings us into how to read a candlestick chart. Here we've got the SPY chart. So as you're looking at, each and every single one of these candlesticks represents one day. So we'll take a look at this first green candle, and you can see that the stock opens right here, and then it starts to pull back, and you can see that by the wick, but it ends up closing that day very strong towards the high and fills the body in green. Then we'll take a look at this candle here, where you can see that it opened, but it ended up pushing up a little bit, you can see by the wick, and then ends up closing much lower than where it opened, but came back up a little bit off of lows, which you can see by the very small wick underneath the candle. So the next day, you can see a very, very long wick, and what this symbolizes is that it had opened, pulled way, way, way back, but then it had some strength throughout the day, bringing it to almost an even close with where it opened, but it still ended up a little bit red. So that's just 3 examples of exactly what's happening, and pretty much a visualization of each and every single day. And you can see how this sort of paints a picture as to what's going on any particular name on any given day. You can also see a little bit of strength off the bottom, where it had a day of quite a bit of range coming off the lows. Then the next day, it gapped up, pushed, pulled back a little bit, and ended up closing at the highs. Same thing the next day, and you can see by those wicks that all the dips are getting bought. And with that, you can see each day it's opening higher and higher because of the strength. As we went over in the last slide, that's an example of a daily candle. But the daily candle is made up of many, many minute candles, which draws that daily candle. So you can see here that during the day, you've got quite a bit of range on this particular name, where it went from 240 to 420 on the day. So it looks like Cam, who put together this slide deck, took a trade on it this day, but you can see that although it's holding a nice trend, it ended up breaking this trend line. You can see that it pushed through 4, ended up pulling back, retested that 4, and ended up putting in a top, which it then started to come in and take a little bit of profits. You can see that on the big red candles, the range on that particular 1 minute. Sometimes it pays to zoom out of the trade a little bit and look at a bigger picture idea. So for example, here with this 5-minute chart, you're basically putting 5 1-minute candles in each candlestick that you see here, which allows you to look at a little bit bigger picture idea. It allows you to potentially take a step back from staring at every single 1-minute candle, where some people may be pressured into making a decision based on one candlestick. On this 5-minute chart, it was a little bit more clear than looking at the 1-minute chart that there was a little bit of resistance being formed at the 280s. And with that, you're able to put a short on, risk off the highs that it had been topping out at 280s, risk off of 3, for the potential pullback and break of support, which you can see formed at the 240 level.
So as Nate was mentioning, different charts have different time frames, and you can change these time frames by, clicking a 1 or a 2 or a 5 or a 15 or a 30-minute or even a daily or a weekly up the top. Right now we're looking at a 1-day chart of Microsoft MSFT. So let's zoom in on this area here on a 15-minute chart. So we're going to zoom out a little. So you can see this candle opened up here, it rallied, pulled back, and pretty much closed at the highs. So I think this candle is going to be a green candle. This candle opened up here, pulled right back, rallied a little. This one here opened up, pulled back, and closed around halfway up the highs. It's still going to be a red candle. However, it's going to have a wick at the bottom. This one opened up, pulled back, and closed off the lows. Another red candle. And this one opened low, had a rally, pushed up, and closed around halfway through. So it's going to be a green candle with a little bit of a wick at the top. So if we have a look at what all this looks like together, and we compare it to what the daily chart looks like when we zoom in, I'm gonna hope that they both kind of look the same.
So our next topic is volume. What is volume? Volume is made up of transactions, which could be hundreds, if not thousands, of transactions at any given time, but all put together add up and are shown on the chart. It adds up all of the prints from the time and sales. So if you're looking at all the different transactions that come across the tape, whether it be 1,000, 200, 800, 5,000, all of those are added up on any given time period, whether it be a minute, 5 minutes, daily chart, whatever you end up picking, and it shows it on the chart. We like to display it on the bottom of our charts so that you can not only see the candlestick at the same time, but you can also see the volume. It allows us to make better decisions, which we'll be getting into later on. You can see that the green volume bars coincide with a green candle, and the same thing with the red bars coincide with a red candle. So next is level 2s, which is one of the most popular questions that I get. On the left side of the level 2, that's considered the bid. And on the right side, that's considered the offer, or also known as the ask. On the left or green side here, these are all people that are waiting to buy something at a particular price. They all have limit orders working, wanting to buy at a particular price, which is less than the offer, which is the right side, which represents everybody that is looking to sell at a certain price. So right now, there's nothing happening. Right now, it's 175.26 by 175.38. Until somebody bids a bit higher or until the offer comes down a bit, there may not be a transaction that occurs. So what is time and sales? Time and sales are transactions. It shows each and every single trade that is made on a particular security. It allows you to see the size. So whether somebody just buys 100 shares, 1,000 shares, 10,000 shares, what time it occurred. And it lets you jump into a little bit of the exact sentiment that's going on. Is it a lot of buyers? Is it just one buyer that came in and took an entire bid or offer? Which allows us to see some information that we might not see on the level 2 or chart.
So in this next section, I'm going to cover the analysis of prints and putting it all together in one head. So right now we're looking at a chart, a level 2, and a time and sales in this stock PRGN. I'm going to look at the analysis of the prints, and what the different colors mean over in this section here. So you can see that there's someone bidding on this stock at $1.70, and they've got 700 shares that they're bidding on at that price. There's someone offering shares at $1.71, and they've got 2,000 on the board here. And right now, there are no transactions taking place. The most that someone wants to pay is $1.70, and the least that someone wants to take is $1.71. But now we're seeing some volume. So people are buying now from that offer. The offer is disappearing because people are eating it up. And now we've moved through that offer. The bid has come up 1 cent. And if people want to buy now, they can buy it at $1.72 from someone selling, or they can put a bid at $1.71 or $1.70 and see if they get filled there. Now you can see all these prints come through here. The green prints mean that the transaction took place on the offer. So a green print means that someone came in and bought it from the offer. A red print means someone sold it to the bid. And everyone always asks me, if red is printing a lot, they're like, oh, there's lots of sellers, right? But if red is printing a lot and the price isn't moving down, it means there's a big bid that's just absorbing all of those sellers. So that could be bullish. Or the inverse of that would be a big offer that's printing a lot of green but isn't moving and the price isn't moving up. It means that there might be a big seller there. So really, I guess my point is, when people are like, oh, there are a lot of sellers or a lot of buyers, for every transaction, there is a seller and a buyer. If someone sells 100 shares to the bid and it prints red, there's someone who's buying on the bid for 100 shares. So the white prints are prints that are filling in between the bid and the offer. So these can be like dark pool prints, and that pretty much covers the color of the prints that you need to know for the time and sales. As the transactions take place, they print on the time and sales, they add the amount of volume to the volume bars down the bottom, and it draws in the price, and that's what creates the candles. At every timed interval that you have your candles set to, whether it's 1 minute, 5 minute, 15 minute, etc., a new candle will start drawing, and that's what makes up the charts. So this next point could be one of the most important parts of trading that I think is often overlooked, and that is the importance of liquidity. So when we talk about liquidity in the context of trading, basically we're talking about the ease to be able to get in and out of a stock, A, without moving it, and B, without being spread it out of a bunch of money. And I'll give you a few examples so that you can understand. If you want to trade 5,000 shares of a stock that trades 100 million shares a day, there were always going to be buyers and sellers interacting at very similar prices to make that market. Your 5,000 shares won't dent it at all. In fact, even if there was 100 people trading 5,000 shares each, there'd only be 500,000 shares of the 100 million share volume for the day. But if the stock that you're looking at trading only trades, for example, 200,000 shares a day, and you're looking to trade 5,000 shares, because that's in line with what your perceived risk is and how much size you'd like to take on, there's the potential that when you go to exit that position, there isn't a ready and willing buyer or seller waiting for you to be able to click a button and be out. And I think it's a huge trap when people are looking at services and quote unquote penny stocks and micro caps and all that world, where they fall into a position of trading less liquid stocks and don't really understand what they're doing in terms of the herd pushing the market around, because the stocks can't actually support all those people moving in and out of it without affecting the price. So this next slide is about the spread, and it's a pretty simple concept, but it's important to note the implications of trading something that is illiquid and how it can affect your account balance. So the spread is essentially the difference between the bid and the ask. So it's really just the difference between what people are happy to pay for it and what people are willing to sell it for. But it's really important not to get crushed by the spread, and that can sometimes happen when trading less liquid stocks. So in this example here, you can see that the best bid is $1.71 and the cheapest offer is $1.74. And this changes all the time, but stocks that have more volume have a tighter spread because there are many more people looking to buy and sell it at any given time. You can see the spread here changing as people are looking to move in or out. So in this example here, let's say you wanted to purchase 1,000 shares and you wanted to be in right away. You'd be paying $1.74 a share. And if you wanted to be out right after you entered your trade, you would get $1.71 for it. So you could place a quick trade and be down $30 without this stock really even doing anything. But this is a fairly liquid stock. The spread is pretty tight. If you were trading something that was less liquid, then the spread might be $1.60 to $1.74. And if you purchased off the offer or the ask, 1,000 shares at $1.74 and went to sell them right away, you'd get $1.60 for them and you'd book a $140 loss in the trade. So the tighter the spread, the better it is for you to be able to get in or out with confidence, knowing that there's going to be some kind of market there for buyers and sellers when you're looking to enter or exit. So what are the minimum kind of thresholds or the minimum numbers or volume or stock prices that we're willing to entertain? Well, essentially, we'll look at any kind of stock price, but as a general kind of rule, we want to look to see that there's more than like $5 million worth of trades during a day. So if it's a $2 stock, we'd be looking for it to have, over 2 million or 2.5 million shares volume. If it was a $5 stock, maybe over 1 million shares volume. Our sweet spot is trading stocks between $1 and $15, but we're happy to trade stocks all the way up to $100. In terms of the sweet spot for volume, it's pretty much the more volume, the merrier. But usually what we see when we're trading momentum names is a $5 stock that has 10 million shares volume in the first half of the day, so you know that it's probably going to trade 20 million shares volume. It's super liquid, so you're going to be able to get in or out without getting crushed by a spread, and you're not going to end up getting stuck in something that you don't want to be in, but you're too afraid to sell because you know that you're getting such bad value compared to what you paid for it. So before we talk about what we're going to be covering in the next lesson, I wanted to go through quickly one thing that you really need to watch out for when learning to trade via social media or watching or following people on Twitter. You really want to avoid people who are touting stocks that are going to the moon. And people can say this in a number of different ways. But essentially what I'm referring to is someone who's in a stock and starts to position their language in an unreasonably optimistic way that doesn't really reflect the reality of the trade. And the way that this ties into the liquidity discussion and the spread and all that kind of stuff that we're talking about in the previous couple of slides is that people only really do this kind of stuff on illiquid names. And it's because they've got a position in the stock at, let's say, 50 cents a share. And the bid is 51 cents and the offer is 65 cents. And they're sitting on the offer at 65 cents waiting for someone to fill them so that they can take their exit. And they'll be touting the stock saying that it might be the next Amazon, or they're hearing whispers that it's having great earnings in a couple of days. And anybody who listens to that and enters on the offer will be fulfilling that person's 25 or 30% win on their 50-cent shares. So one very important rule that I always use when trying to digest information to see where the person's at who's giving it is it possible for this person to benefit from what they're saying? Now for us, when we're trading stuff that has 10 million or 20 million shares traded on a day at a $5 stock, it pretty much doesn't matter how big your following is, you can't affect the price of that stock. Whereas if you're trading something that maybe has 100,000 shares volume or even 250,000 shares volume, and you've got a big following base, then those comments may move around the stock price. And we don't believe in that. We think that's not right. So we try and avoid the people who do that and also avoid all the stocks that they're trading. So I'm pretty happy with how much we got through this lesson. We talked about a bunch of key concepts that I think belong in the beginner series, but sometimes take a little bit more explaining to understand. If you liked what you were listening to, please give it a thumbs up. It helps me get fired up about making more vids for free for you guys for the YouTube channel. Feel free to comment in the comment section. I see them all. Or drop me an email. It's cam@investorsunderground.com if you want to chat a little bit about your trading, or if you're interested at all in becoming a member of the Investors Underground community. In the next lesson, Nate and I are going to be talking about bullish chart setups. So that's going to be a lot of fun. I'm really looking forward to being able to put that out for you guys. If you haven't already subscribed to the YouTube channel, it's free. You can do so by clicking this button here. And it just means that whenever I put out a new video, you're not going to accidentally miss it because you don't know it's out. This has been Cam for Investors Underground. Good luck with your trading.